Mutual funds. In mutual funds, there are three concepts. One is mutual fund return, another one is calculation of NAV, another one is mutual funds performance evaluation. This is what we are going to do one by one problems now. Question number 1. Calculation of the mutual funds. See, friends, we are going to talk about mutual funds. How mutual fund will work, how mutual fund will perform, how mutual fund calculation of NAV, how those performance evaluation we are going to talk now. See, calculation of the return. For example, we see one problem. Mr. A can earn a return 60% by investing in equity shares on his own. Now, he is considering recently announced equity-based mutual fund scheme in which initial expenses is 5.5%, annual recurring expenses is 1.5%. How much should the fund earn to provide Mr. A return at the rate of 16%? And ascertain the target expenses ratio in case of mutual fund earn 18%. Ascertain their initial expense ratio in case of mutual fund earn 19%. So this is the scenario, friend. Now we are going to calculate how. Somebody messaged me. Okay, no issue. Demon something there. Okay, leave it. So now, for example, mutual fund return, the M of return is equal own return divided by 1 minus initial expense ratio plus annual expense ratio. That is called mutual fund return. For example, in this case, own return is 16% and initial expense ratio is 5.5% and annual recurring expenses is 1.5%. How will you calculate now? You see the first, take pen and paper, my dear friends. Mutual fund problems and solutions. Problems and solutions. Mutual funds, problems and solutions. MF written is equal to question number one solution. Question number one solution and answer. MF written working note number one. Note number one. MF written MF written is equal to own written own written divided by 1 minus initial expense ratio 1 minus 1 minus initial expense ratio expense ratio initial expense ratio plus annual expense ratio annual expense ratio annual expense ratio. Friends, while we are solving problems and solutions regarding to the mutual funds, we would like to tell you that first we are going to solve n number of problems and solutions. While solving the problems and solutions, wherever concepts come, we'll discuss in detail and in depth. That's what, my dear friend. And today afternoon, we would like to discuss about we would like to discuss about financial instruments and today our target is mutual funds and financial instruments and audit part is due diligence. This is what our target today, our friends, and we'll see how we can execute our things. See, what I would like to tell you first, we can discuss theory as well as problems and solutions. But now I would like to discuss first problems and solutions along with theory questions. So let's understand the scenario of the mutual funds by theoretically and as well as theory as well as problems we are going to solve now, my friends. In the case of financial instruments also, first we would like to talk about theory and simultaneously problems and solutions. See, mutual funds, page number 40. See, a mutual funds introduction. The mutual funds is a financial doctor for manage the investor money. A sponsor entity that establish mutual fund and gives initial capital. The trustee ensures mutual fund operations in the best interest of the investors. AMC charges the fund investments, incurs expenses and recovers it's as part of expense ratio. Investors, unit holders. Mutual fund introduction. A mutual fund return versus individual return. Return to be earned by a mutual fund to give same return which an investor would get on his own without opportunity cost. Mutual fund return is equal to individual return divided by 1 minus IER plus AER. With opportunity cost, do cost benefit analysis to check which is better. And mutual fund return versus individual return. A return is a function of the dividend and capital appreciation for investor. A return is equal to what I get back and what I give and divided by what I give. That's called return. Dividend allows on face value always. And return is equal NAV1 minus NAV0 plus D1 means dividend plus capital growth percentage divided by NAV0. A return is equal to NAV1 minus NAV0 plus D1 plus CG1 divided by NAV0. Friends, what is meant by NAV0? The initially you invested a 5 lakhs on mutual funds. That 5 lakhs at the year end, how much was earned? The 5 lakhs appreciation went 5 lakh 50,000. Then that is NAV1 is equal to 5 lakh 50,000. Here, any dividend growth is there, that growth, and any capital appreciation is there, that divided by NAV0 is equal to the return. There are two kinds of returns over there in the market. One is holding period return, another one is annual return. Holding period return, same formula as above, which we used earlier. That's called return is equal to NAV1 minus NAV0 plus D1 CG1 divided by NAV0. Whereas whereas annual return annual return above formula multiplied with 12 into 12 divided by m. So now we will see the holding period return versus annual return. Dear friends, the period of holding through holding period return and annual return, the holding see what I want to tell you, the period of holding through holding period return and annual return. See, period of holding is equal holding period return divided by annual return into 365 days or 12 months, then a, a period of holding will come. And a period of holding day or months calculate or calculation for annual return. Question specifies that a year consists of 360 days or 365 days. Do return computation on number of days, and no such information do computation on months basis. Return computation days versus months. Number of days is equal to redemption date minus investment date. Redemption date minus investment date. Consider date of redemption in days calculation and ignore date of investment in computation. Dividend declared by mutual fund, dividend rate into face value. Dividend dividend payout plan paid in cash. Dividend payout plan paid in cash. Return computed using formula of concept 3. Dividend reinvestment plan. Dividend is reinvested and given extra units. Holding period return is equal to closing value minus opening value divided by opening value into 100. That's called holding period return. Dividend dividend payout plan and dividend reinvestment plan. According to concept number 9, a computation of the closing units, dividend reinvestment plan, date, unit held, percentage, dividend is equal to the face value into dividend percentage, reinvestment NAV and new number of units and total units. Bonus plan, date, units held, bonus ratio, bonus units is equal to B is equal to A into bonus ratio, total units A plus B. Date, unit held, bonus ratio, bonus units and total units. Friends, this is not a complexity problem. The concept is, see, earlier we have seen a dividend declared by mutual funds is equal to a dividend rate into the face value. Dividend payout plan paid in cash, return computed using formula according to concept 3. Whereas dividend reinvestment plan, dividend is reinvested and given extra units. Then holding period return is equal closing value minus closing value minus the opening value, closing value minus opening value, closing value minus opening value divided by opening value into 100. This is called holding period return. Okay, now how to compute the closing units? That's technique we should know it. How you need to do? Take column number 1 is the date. Take column number 2 is the units held as on date. And column number 3, you compute how much dividend come, the dividend into the face value into the percentage, face value into dividend percentage, that will come as a dividend column. Now reinvestment is the C column. Now new units is equal D is equal B by C, means the dividend divided by reinvestment price how much. If you divided by that, you will get number of new units. Now the opening units plus closing units, opening units plus reinvestment units, then together will comes is closing units, opening units, and then dividend come. That dividend, instead of you taking out your pocket, you reinvested with that price, then they issue new units, then it will come as total units. Now friends, for example bonus plan is there, then you consider date, units held, bonus ratio, bonus units is equal units held into bonus ratio. Then if you Computed opening units plus bonus units together will come as a total units. This is what, my dear friends, is the bonus plan. Friends, types of the mutual fund schemes. Open-ended scheme, entry and exit at any time. Return computed using formula of the concept tree. Friends, unit holders. There are two types of mutual fund scheme. One is open-ended, another one is closed-ended. Open-ended scheme, entity and exit at any time. Return computed using formula concept tree. Close-ended scheme, entry and exit at specified time, listed in stock market to facilitate purchase and sale. Purchase and sale cannot happen at NAV. Understood, friends? Listed in stock market to facilitate purchase and sale. Purchase and sale not happen NAV. Replace the NAV and NAV 0 with adjusted price in a formula. Now, friends, written for the closed-ended scheme, the taxation impact, cost of acquisition of the bonus units 0. Security transaction tax is not tax deductible expenses for computing the capital gain. The taxation impacted effective yield return computed as annual return through formula ignore the time value of money, hence not fully accurate. Compute return as IRR of the investor, day zero outflow of the investor and maturity inflow of the investor is equal to the computation of the IRR and effective yield. My friends, the load in mutual funds, a front end load and back end load. The front end load is the entry load, back end load is the exit load. Load in load in mutual funds. There are two loads. One is front end load, another one is back end load. The front end load is the entry load, back end load is the exit load. So the collected extra on entry and hence increase the purchase price. That is equal public offer price minus NAV divided by NAV is equal to the load of the entry load. Whereas the back end load collected on exit and hence decrease the redemption price NAV minus redemption price divided by NAV. In India, we don't have entry load, but we have exit load. That also exit load within the 1 year you sell, exit load is there. After 1 year, there is no exit load on the mutual funds. Okay, friends. Now, let's go for the take concept number 12. The front end load, back end load, the front end load, back end load, the NAV fair value of the per unit of the mutual fund and assets and liabilities detailed available in Formula 1. Assets and liabilities not available in Formula 2. There are with two formulas we are going to compute the front end load, back end load, my dear friends. Now, friends, let's come back to the we are studying the first theory part and then we'll go for once you are grip over on the concepts, would like to go solve number of problems and solutions on the mutual funds. My dear friend. Now, let's go back to the calculations of the mutual funds. Formula 1. Formula 1 means what? You have information with respect to assets and liabilities. Then I am going to calculate NAV likewise. market value of assets minus value of the liabilities divided by number of units. This is called the formula where you have assets and liabilities information, then calculation of the NAV equal market value of the assets minus value of the liabilities divided by number of units is equal to come as a NAV. Whereas if you don't have assets and liabilities information, then you go like this: opening net worth plus item increasing net worth minus item reducing net worth divided by opening units plus new units issued minus redemption. Opening plus new units minus redemption. Like this will come, my dear friends. Now we will go back to calculations how it impacts of events on net annual value. We'll see now. The fresh purchase or redemption, no impact as numerator and denominator is impacted. Whereas the fresh purchase redemption, no impact as numerator and denominator is impacted. Whereas the dividend declaration, NAV fell by the amount of dividend per unit. This is what impact on the NAV, my dear friends. Now let's go back to the concept number 16 and 17. It talks about the total yield of the investor applicable when an investor is investing in mutual fund. A capital gain of all mutual fund plus dividend of the all mutual fund. Understood, my friends? Anybody have a doubt, please call me. My mobile number 9677205265. Friends, what I want to tell here under the concept number 16 and 17, total yield of investor applicable when an investor is in investing multiple mutual funds. The capital gain of all mutual fund plus dividend of the all mutual fund divided by amount invested in all mutual fund. Dividend from category 1, dividend from category 2, together A plus B divided by accumulated mutual fund is equal. You can you can arrive the figure how much yield comes. Now, friends, if you look back, total yield of the investor, the exit strategy of the underperforming mutual fund. No exit load. Exit load, exit immediately. Whereas exit load, sorry, okay, okay. See, like this. How you computation of the yield? That's the question. Now, you see total yield of investor applicable when investor investing in the multiple mutual funds. Then capital gain all mutual fund plus dividend of all mutual fund divided by amount invested in all mutual fund into 100 is the answer for that. So that's why capital gain of all mutual fund plus dividend of all mutual fund divided by amount of invested in all mutual fund into 100. Now, concept number 6. Friends, I would like to tell you like this what I could say, what I want to say. Existing strategy in the mutual funds, underperforming mutual fund. No exit load, exit can be done immediately. Exit load exists, check proportionate loss in the return as compared to exit load and decide. Okay. Now, exit load versus lower return from mutual fund, a tracking of each inflow and outflows. Not possible. Record cash as an asset if it given for NAV computation, else ignore it. Tracking of cash inflows and outflows possible. Prepare cash book and compute closing cash and considering NAV. Friends, what I would like to talk here, what I want to say, the meaningful, nice, important, very, very, very important thing to come in exam. The point is, there are two things, either possible, not possible. Tracking of cash flow, tracking of tracking of cash inflows and outflows, not possible. Record cash as an asset if given for NAV computation, else ignore it. If possible, prepare cash book and compute closing cash and consider in NAV. Just 2 minutes break. I would like to bring concept number 18 and other stuff. Just 2 minutes wait. So we'll complete the mutual funds and then I'll go for water and drink water. That's it. Friends, sorry, give me some time. I'll be back and reconnect. We'll discuss a few more concepts in mutual funds. I'll come back to discussion after some time, half an hour, because I'm going to drink water. Thank you, darling. Otherwise, I can complete this now. How much time will take? Only one page only now. So okay. We'll close now itself. We'll close now itself because we don't want to take much time. See, there are exit strategy underperforming the mutual funds. If exit load, no exit load. Exit load exists. Check proportionate percentage loss in return as compared to exit load and decide. No exit load. Exit immediately. Exit load exists. Exit load exists. Check check proportionate percentage of loss in return as compared to exit load and decide. Friends, the exit strategy underperforming mutual fund, there are two: exit load exist and no exit load. No exit load, exit immediately. Exit load exists. Check proportionate percentage of loss in the return as compared to exit load and decide. Exit load versus lower return mutual funds. Tracking of cash inflows and outflows. Either possible, not possible. Not possible, record cash as an asset if gives for NAV computation, else ignore it. Whereas it possible, prepare cash book and compute closing cash and consider in NAV. Cash balance computation to value NAV. Dividend income of mutual fund on its investment, original shares applicable and will be received. Right shares, bonus shares will not be applicable in case dividend declared before allotment of bonus right shares. Dividend income on equity shares. Mutual fund reports daily NAV. Yes, no need to do dividend equalization adjustment. No, mutual fund reports daily NAV. Yes, no need to do dividend equalization adjustment. If no practical words, this option is not there. Purchase NAV is equal to opening NAV plus entry load plus dividend equalization per unit. Redemption of NAV is equal to opening NAV minus exit load plus dividend equalization per unit. Dividend equalization per unit is equal total income earned divided by number of units. Income available for distribution is computed to identify the amount of dividends which can be distributed. Let us assume there are 3 months in the calculation period. Income per unit is equal total income divided by number of units of the month. Income available for distribution is equal month 1 income per unit plus month 2 income per unit plus month 3 income per unit into closing units. Concept number 24, income available for distribution. Dividend out of realized earnings, dividend distributed is equal realized earnings into specific percentage. Realized earnings is equal dividend divided by interest income of mutual fund plus realized capital gain. Friends, if you see the concept number 20, the concept number 20 says that concept dividend income available for distribution, dividend out of realized earnings, dividend distributed is equal to realized earnings into a specific percentage. Realized earnings is equal dividend divided by interest income of mutual fund plus realized capital gain. What? Dividend divided by interest income of the mutual fund plus realized capital gain is equal to realized earnings. Now, the dividend out of realized earnings, valuation of assets, equity shares, bonds. Equity shares, amount invested into closing index value divided by index on date of investment. Equity shares, amount invested into closing index value divided by index on date of investment. Bonds, interest in rupees divided by current yield in percentage. Valuation of equity shares and bonds for NAV computation. Expense ratio, amount incurred by mutual fund such as office expenses, rent, fund management expenses, etc. Expense ratio is equal to annual expense per unit divided by opening NAV or closing NAV or average NAV into 100. Expenses ratio is equal to amount of expenses per annual expenses per unit divided by opening NAV or closing NAV or average NAV into 100. Okay, friends, this is your people's advocate Srimanarayana Malila. Mutual fund performance evaluation, undiversified mutual fund, share Sharpe ratio or reward to variability ratio, diversified mutual fund, trainer ratio or reward to volatility ratio, either of them, Johnson Alpha. See, the mutual funds performance evaluation, 3 categories. Undiversified mutual fund, Sharpe ratio or reward to variability ratio. Diversified mutual fund, trainer ratio or reward to voluntary ratio. So diversified, Trainer undiversified Sharpe ratio. Either of them is an alpha. See, the formula for the Sharpe ratio is expected return minus risk-free divided by standard deviation is called Sharpe ratio. Friends, trainer ratio, trainer ratio is equal to expected return minus risk-free return divided by beta. Trainer ratio is equal to expected return minus risk-free return divided by beta. So Sharpe ratio is the better. Trainer ratio higher is the better. Alpha is equal to actual return minus required return as per CAPM. Higher positive alpha is better. Values can be negative if mutual fund return is lower than risk-free return. Breakup of NAV: cash component, equity component. Cash component will decline by expenses per unit, whereas equity component will increase or decrease based on the market change. Closing NAV is equal to cash component plus equity component. Equity component is equal to opening value plus or minus percentage change. Percentage change is equal to beta of the portfolio into change in market. Beta of the portfolio into change in market. Tracking error. Dear friends, what is meant by tracking error? A tracking error is applicable for the mutual fund which track any index. Example, Nifty index into mutual fund. I compute the amount of the variation in performance as compared to the index. Understood, my dear friends? This is the theory of mutual funds, what we studied till now. And next video, we are planning to do number of problems and solutions, my dear friends. So this is what we planned our brain, my dear friends. We will discuss a lot with respect to the problems and solutions. Now there are around 29 or 30 questions are there in the mutual funds. One by one we'll solve. Very easy. The mutual fund is very, very, very easy chapter. Friends, thank you. You patiently participated in my class, and I would like to grateful and thanks to everyone who are watched my YouTube channel and understand this subject. Who somebody approached me by calling, asking the doubts. I'm really happy to teach what I know, my friends. Thank you, and all. Bye.